The UK housing market is collapsing, buyers are gone, prices are in freefall, whole cities are being abandoned. The UK property market is bleeding out in 2026. Here are the 12 cities hit hardest, starting with the worst. Number 12. Portsmouth. Portsmouth should be holding up. Naval heritage, a coastal location, a university. And yet the Office for National Statistics data released in March 2026 tells a different story. The average house price fell 4.1% in the year to January 2026, from £256,000 to £246,000. Nearly £10,000 erased in 12 months. Flats fared worse, down 6%. The wider southeast saw virtually no annual change. Portsmouth is bucking regional trends and moving downward. Buyers who might once have chosen Portsmouth have recalculated under a mortgage rate environment where 2-year fixed deals crept toward 5.9% in 2026. Properties priced above what local wages support are the first to soften. If you own here and were waiting for recovery, the January 2026 Office for National Statistics data is not sending that signal. Number 11. Ipswich. Ipswich looks stable until you examine what lies beneath. Office for National Statistics data for December 2025 shows prices roughly flat year on year. But that stability follows a period in which Ipswich recorded a 7.1% annual fall, the steepest decline of any district in the east of England. That correction leaves homeowners underwater and suppresses turnover for years. At the same time, private rents rose 4.9% in the year to January 2026, reaching £983 per month. Rising rents alongside stagnant purchase prices signal that households want to live here but cannot stretch to buy. When the first-time buyer pipeline thins, the sellers of starter homes have fewer takers. Buyers here have leverage they are not afraid to use, and sellers who refuse to acknowledge that are facing a very long wait. Number 10. Lincoln. Lincoln does not feature prominently in national property conversations, which is exactly why Zoopla's 2026 postcode level analysis deserves attention. 40% of homes listed for sale in Lincoln have been sitting on the market for more than 6 months. 4 in 10 properties cannot find a buyer within half a year. That is not a slow market. That is a market where sellers and buyers are living in different realities. Zoopla describes Lincoln buyers as increasingly selective and price sensitive. The city has genuine assets, a cathedral, a growing university, reasonable connectivity. But those have not translated into competitive bidding. Buyers are deliberating, submitting offers below the asking price, and walking away. A property sitting unsold for 8 months is being actively rejected at its current price, and the longer it sits, the deeper the eventual discount required. Before we get into the top 9, if this kind of data matters to you, subscribe now and hit the bell. The cities still to come have seen price falls and structural conditions that will disturb anyone who holds property there. The city at number 1 has a story that every property owner in England needs to understand before making any decision in 2026. Number 9. Aberdeen. Aberdeen has been declining for over a decade, and the 2026 data confirms the recovery has not arrived. The Office for National Statistics UK House Price Index for January 2026 records the average house price at £133,000, a fall of 4.5% from £139,000 a year earlier. Scotland's average rose 1.3%. Aberdeen is moving in the opposite direction to its own country. Between 2010 and 2024, the city lost approximately 18,000 energy sector jobs, according to Offshore Energy's UK. When a city ties its economy to one industry, and that industry contracts, housing demand contracts with it. Detached properties fell 5.3%. Terrace properties fell 3.4%. First-time buyer entry now sits at £113,000. That sounds attractive to buyers, but cheap prices in a market that has been falling for over a decade are not automatically an opportunity. They can be a value trap, and the economic catalyst this market needs has not yet appeared. Number 8. Crawley. Crawley sits in the home counties, historically shorthand for a guaranteed floor under property values. That assumption is being tested hard in 2026. Lloyd's banking data cited by the New Statesman in January found that house values in Crawley and nearby High Wycombe fell between 7 and 9% in the preceding year. A 9% fall on a property worth £350,000 is more than £31,000 gone. For homeowners who stretched to buy at the top of the post-pandemic surge, that figure is the difference between comfortable remortgaging and a difficult conversation about negative equity. Crawley absorbed demand during the pandemic flight from London, pushing prices to levels the local wage base cannot sustain. When professionals realised remote work did not require a commuter belt postcode, that demand evaporated. The local economy, even with Gatwick employment, does not generate income sufficient to hold pandemic-era valuations. Sellers who bought from 2020 to 2022 are discovering the market moved against them. Number 7. Wigan. The Centre for Cities Outlook 2026, published in January, is one of the most data-dense assessments of urban economic health in the country. Its findings on Wigan are sobering. Real terms disposable income fell 1.6% over the decade since 2013, meaning residents are worse off today than they were 10 years ago. Had Wigan matched top-performing peer cities, residents would be approximately £7,200 better off. That gap represents wages not paid, careers that left the city, and buyers who were never present to absorb housing stock coming to market. Wigan is among the cities where Centre for Cities identifies the most persistent disconnect between economic activity and household income growth since the financial crisis. Property is inexpensive and draws buy-to-let interest for that reason. But inexpensive and improving are not the same thing. Number 6. Dundee. Scotland's property market is performing strong in 2026, with national average prices rising 4.9% in the year to December 2025. Dundee managed 2%, less than half the Scottish average. When a city underperforms its own national market by that margin, the question is why. Dundee carries persistent deep deprivation in specific inner areas. The waterfront regeneration and the V&A Museum brought genuine investment and optimism. The question for 2026 is whether that translated into broad economic improvement or simply created a cultural quarter while surrounding areas face unchanged pressures. Private rents held flat at £827 per month in the year to January 2026, barely moving while rents across Scotland rose 2.6%. A flat rental market signals a constrained tenant pool. For inner residential area owners away from the waterfront, the trajectory is modest prices and limited near-term upside. Number 5. Nottingham. Nottingham has genuine strengths. With 2 universities, a large student population, proximity to East Midlands logistics and real city centre investment. And yet, the ONS data for January 2026 places the average house price at £194,000, almost exactly where it was 12 months earlier. In a year when inflation ran above 2%, flat nominal values mean declining real terms values. Flat prices fell 2.5% in the year to January 2026. Hamptons found that 38% of new build flats across England and Wales sold for a loss in 2025. Centre for Cities estimates that if Nottingham had matched top-performing cities on income growth over the past decade, residents would be approximately £5,000 per person better off. That is the spending power never generated, and the buyers never present to absorb supply. For flat owners in particular, 2026 demands patience and realistic pricing. Number 4. Coventry. Coventry carries an uncomfortable dual distinction in 2026. Centre for Cities identifies it as one of the Midlands cities where income growth has most persistently lagged economic output, with residents estimated to be approximately £5,000 per person, below the trajectory of top-performing cities over the past decade. Coventry has also been cited as a city warning. It may have to issue a Section 114 financial notice following Birmingham and others into the most serious category of local authority financial distress. When a council approaches that threshold, the consequences reach into neighbourhoods immediately. Parks deteriorate, planning slows, and community services close. These are conditions buyers notice and price into their offers. Changes to landlord taxation in the 2025 budget have also accelerated the exit of smaller private landlords, adding supply into a market where buyer demand is already constrained. Number 3. London flats. This entry addresses one segment of one city, but it is large enough and consequential enough to stand alone. London's leasehold flat market is experiencing what analysts now describe as a structural repricing. Figures released in March 2026 show the average London flat fell £19,000 in the year to January 2026, from £450,000 to £431,000. Since early 2023, the average London flat has lost approximately 7% of its value. Bloomberg reported in March 2026 that London home values fell 1.7% year on year, the steepest decline since February 2024. Hamptons found roughly 2 in 5 owners who bought a new build London flat in the past 20 years sold for a loss in 2025. In Hammersmith and Fulham, 2/3 of new build flat owners who sold received less than they paid. Service charges rose an average of 41% between 2019 and 2024. Leasehold reform is law, but not yet operational, with the average 2-year fixed rate climbing from 4.83% in early March 2026 to 5.9% by early April 2026. Buyers are finding it harder and more expensive to borrow. The data does not suggest waiting improves the outcome for sellers. Number 2. Birmingham. Birmingham is the UK's second largest city and holds a distinction no city wants: the issuer of the largest Section 114 bankruptcy notice in UK local authority history. Issued in September 2023, that notice exposed a financial catastrophe, a projected deficit that could have wiped out the council's general fund, combined with an equal pay liability that grew to £815 million. Since then, Birmingham City Council has sold over 1,000 properties and land holdings, raising more than £250 million in asset disposals toward its £1.255 billion capitalisation requirement. Community centres, historic buildings, land reserved for future development, the fabric of the city was liquidated to pay for 2 decades of governance failures. Parks, youth services and planning capacity, every service that makes a neighbourhood livable, have faced cuts the council's own commissioners describe as among the most severe applied to any major UK city. Office for National Statistics data for January 2026 shows Birmingham's average house price at £231,000, essentially flat year on year, while flat prices within that aggregate fell 2.7%. The council targets a balanced budget in 2026 to 2027 for the first time in 3 years. Whether that translates into buyer confidence or whether deep service cuts leave a lasting mark on livability is the question defining Birmingham's property market for the rest of this decade. Number 1. Birmingham, the data that property owners cannot ignore. Returning to Birmingham at number 1 is not repetition for its own sake. It is because the scale of what property owners here are navigating in 2026 is unprecedented in UK urban history. A local authority carrying a £1,255 million capitalisation direction. Asset sales exceeding £250 million, with a £750 million target still to be met. The deepest discretionary service cuts applied to any major UK city. A flat market already in nominal decline, real-term household incomes that have failed to grow for over a decade, and a private property market still priced as though stability is the default when the data confirms the disruption is already 2 years deep. For owners of investment property in Birmingham, particularly flats, particularly in inner-city locations outside confirmed regeneration corridors, the Centre for Cities Income Analysis, The ONS flat price data, the Hamptons loss data, and the Birmingham City Council Commissioner's own published reports are the documents that matter most. All are publicly available. Not one describes a market on the verge of recovery. They describe a city navigating structural underperformance, a local authority financial crisis of historic proportions, and a national mortgage environment where rates have moved sharply against both buyers and sellers. These 12 cities are not beyond recovery. Communities are resilient, and investment does arrive in places that once seemed written off. But the data available in 2026, from the Office for National Statistics House Price Index, Centre for Cities, Zoopla's postcode analysis, Hamptons loss data, and official council documents, identifies these as the cities where structural pressures are bearing down hardest on property values and on the people who hold them. Property decisions are long-term decisions. Make them with the long-term data, not with the optimism of someone who profits from your signature. Subscribe now and share this with anyone facing a property decision in 2026. The data is public. Most people never look at it. Now you have it.